All right, welcome to The Explainer. Today we're digging into a real head-scratcher, something happening in the global markets that it doesn't seem to make any sense.
So, here's the big question, right? Why is bad news for the economy suddenly looking like good news for the market? I mean, you've got all this genuinely worrying economic data coming out, and yet the stock market is rallying. It feels totally backwards, doesn't it? So how can bad news actually drive prices up? Let's get into it. Okay, so the story really kicks off with one pivotal event, a single speech really, that just completely flipped market expectations on their head. And yeah, it came from the most powerful central bank on the planet, the U.S. Federal Reserve.
Now, Fed Chair Jerome Powell used this one specific phrase, a shifting balance of risks. I know, it sounds like that typical dry central banker talk, but trust me, for the market, this was a huge signal. It was code. It meant the Fed was pivoting. They were basically saying, okay, we're not just worried about inflation anymore. Now they're just as concerned, maybe even more concerned, about a potential economic slowdown. And the market's reaction? Oh, it was instant. Before that speech, traders were pricing in, maybe a 70% chance of an interest rate cut in September? But right after, boom, that probability shot up to nearly 90%. All of a sudden, investors were betting big that the Fed was about to make money cheaper to borrow, to prop up the economy. And this really gets to the heart of it, understanding this one term, dovish. When you hear us say the Fed signaled a dovish pivot, what we mean is they went from being aggressive or hawkish, fighting inflation with high interest rates, to being much softer or dovish. A dovish stance favors lower rates to protect growth. It's really that simple. Think of a hawk versus a dove. One's aggressive, one's gentle. And that shift is everything right now.
But, the Fed didn't just wake up one morning and decide to pivot. Nope. This dovish signal was a direct response to some really loud warning bells ringing all over the world. The bad news that was forcing their hand, it was coming from pretty much everywhere.
And this slide just lays it out perfectly. I mean, look at this. On one side, you've got Germany, Europe's economic engine, and its economy is actually shrinking. It's basically knocking on the door of a recession. Then, on the other side, you've got China, the factory of the world, right? Well, their industrial output and consumer spending have slowed down to levels we haven't seen in years. And let me tell you, when these two giants start to stumble, the entire world feels it.
So this is where we get this really strange dynamic, right? You've got weakening global growth, which is causing the Fed to hint that it's going to step in with cheaper money. And it's the hope for that cheap money that's creating this massive ripple effect across financial markets, so much so that it's completely overshadowing the actual bad news.
I mean, just look at Wall Street, a huge rally. The S&P 500, the Dow, the Nasdaq, they all jumped. The Dow even hit a new all-time high. And the logic here is pretty straightforward. Lower interest rates mean it's cheaper for companies to borrow and invest, which makes their future profits look a whole lot better.
And at the exact same time, what happened to the US dollar? It got weaker, dropping by almost a full %. And this makes perfect sense, right? If US interest rates are about to fall, why would you want to hold on to dollars? They're just not as profitable. So what do investors do? They sell.
So where did some of that money go? Well, a lot of it went right into gold. The price jumped to $13.70 an ounce. Think about it. Gold doesn't pay you any interest. So when interest rates at the bank are falling, suddenly holding on to that shiny metal doesn't seem like such a bad deal. It becomes a much more attractive, safe place to park your cash. And this optimism, it just spread everywhere. Crude oil had its first weekly gain in a while, all on the hope that this central bank action would goose the economy and, increase demand for fuel. Stock markets all over the world, from Europe to Asia, they just followed Wall Street's lead. Even industrial metals got a little bit of a lift. It's like the entire market was singing the same song. Don't worry about the economy. The central banks have got our backs.
So all of this brings us right to the fundamental conflict, the thing that's at the very heart of the market right now. It's a classic tug of war. You've got two incredibly powerful opposing forces pulling in opposite directions.
And this right here is really the core takeaway. On one side of that rope, you have the grim reality of a slowing global economy. On the other side, you have this powerful hope that the central banks can just fix everything with a flood of easy money. And for now, hope is winning. The key thing to remember is that investors aren't betting on the economy we have today. They're betting on what they believe the central banks are going to do tomorrow.
And that leaves us with the ultimate question, doesn't it? This whole market rally, it's built on the promise of a cure. But what if the disease, this genuine global slowdown, is actually more serious than investors think? Is the medicine, this easy money, really going to be strong enough to fix it? Or are we all just ignoring the symptoms of a much, much deeper problem? I guess that's the billion-dollar or maybe trillion-dollar question the market is going to have to answer next.